Let me now introduce and welcome Ravi Dharamshi of ValueQuest Advisors to take our conversation forward. Ravi, always fantastic to have you on ET Now. Thank you for joining us. Ravi, let's start with the mood point. How would you assess the market? How do you assess the market right now? FY24 has been nothing short of a year of grand returns. Are gains likely to extend themselves? They may be lower, but are we in for a positive year? Are we in for another positive year?
I think it will be a tale of two halves for sure. First half is likely to be positive, and we clearly awaiting two big events, which is one is election and other is interest rate, and in two different geographies. India rate cut as well as election results most likely to be positive for the market, but in US that's where the joker in the pack lies. Interest rate cut might still go ahead as planned, but the election might throw up a surprise, and that can lead to some kind of volatility in the market. So I think that is what we are looking at. Currently, the positive momentum continues, but second half can see some volatility.
And why do you think second half will see volatility? Is it because of US elections?
Yes, US election is the key over here. And once all these events are also out of the, kind of markets have kind of factored that in, then we will probably be back to looking at the earnings, and that can actually throw up some negative surprises also, because not everything is firing in full cylinder as one would expect.
Everything is not firing full cylinders. What exactly are we referring to?
So clearly the rural consumer is not yet, doing very well. The discretionary consumption at the bottom of the pyramid is not doing very well. Exports are not that strong. So those are the areas of concern from the larger macro point of view. However, that's where the opportunity also lies. Markets have recognized that these are the problem areas, and that's why these stocks have not been performing since last 2 years or so. So that's where the opportunity lies if there was to be a revival. But I think this entire rotation in the market, the current recovery is totally investment led, and that too government Capex led. So that changing from handing over the baton from the government led Capex to private led Capex will happen this year. Also, maybe some amount of at the market level change of guard will happen from investment led theme to consumption led theme towards the end of the year.
While we spoke about US elections and global interest rates, we've got a local election, which everybody is saying is almost like a no event right now. But after that, you have a budget. So do you think rather than elections, we should focus on budget, and that could be an element of volatility coming because of that?
No, I think just as much as election is a non-event, I think budget is pretty much a non-event as well. It's been pretty well laid out. What are the priority areas for this government? How is this government going to approach? They are trying to push the envelope on the investment side, but I think incrementally from this point on, their ability to push more investments is limited. So they need the private sector to kind of fill in the gap over there. So I don't think even budget can throw up any kind of a surprise which none of us has ever thought about.
So like a deep and a very shaky sell-off in mid and small cap stocks in the month of March. Do you think the froth in the mid and the small cap space is over? Markets have now adjusted?
So first of all, I would say the froth is a strong word, but if you had to say that word, it is more in the SME space than in the mid and small cap space. The degree of euphoria or bullishness varies from space to space. So SME has the maximum, kind of froth over there, which has kind of corrected itself due to the regulatory nudge, and I think it was more definitely required. But mid and small cap, you can say, are probably a standard deviation above its long-term average, which makes it on the expensive side, but I won't call it a euphoria or a bubble. That's a too harsh a term in my opinion. And on the other hand, the large cap space is definitely looking attractive. So I think we have the entire gamut, entire spectrum available in the market. I won't be worried about a small spot in the market being a little frothy, because that would be like tail wagging the dog.
A lot of market experts are maintaining that PSUs were the leaders and PSUs will be the leaders, and by all PSUs on decline. As a house, How have you approached the PSU stocks?
See, our approach has been very, very clear. First of all, PSU is a basket that is defined by the market. We don't look at government-owned companies as a separate basket. What we look for is themes that cut across all sectors. So, what has been exciting for us is, so if there is a energy transition as a theme, or whether it is financials, revival in the economy, those kind of themes. Now, if there are players within PSU sector that have the right to win that space, that is what excites us. So, for example, defense is one thing that we were bullish on for the last 3 years. There is only PSU defense as a sector that exists. Private sector is virtually non-existent. So, in that kind of a case, absolutely we would buy PSU defense companies. But if you tell me about banking, larger banking companies, then I don't believe that any of the PSU banks have a right to win over there. They are a beneficiary of more a cycle rather than any kind of and the valuation arbitrage existed between the PSU and the private. I think that valuation arbitrage has played out. Now incrementally, I think only a company or a bank that has managed to stand itself apart from the rest of the pack, men and the boys will be separated. So be on the lookout for that.
Ravi, so the themes which we've identified, which are centered around financials, manufacturing, energy transition, digitalization, are those themes still intact?
Very much intact. The problem is that those themes are still very strong, but the markets have also recognized. I cannot say for anything that is totally recognized in the market, or market has not paid any cognizance. All these stocks have rallied. So getting a combination of a theme that is relatively unnoticed in the market, or is very attractively priced, is the challenge that we are facing right now. But having said that, there are still a couple of themes where valuations are attractive, and the theme also seems to be playing out over the next 5-8 years. The probability is getting stronger, so I don't expect the stocks to get cheaper over there.
Okay, so let's look at electronic manufacturing, and I'm just looking at public information here. This is pure public information. It's not a recommendation. Let's say you've invested in companies like Keynes. This is a pure play on EMS. But the run-up in some of the EMS stocks, which are especially in manufacturing, hasn't that been extraordinary? I mean, while this is a great theme, but do you think this theme is something which is now, I mean, it is like gold is now trading at the price of diamond when it comes to EMS manufacturing?
I don't disagree with that. I think the valuations are stretched, but the valuations are stretched in context of the current earnings. Now, if it is a trend, a larger decadal trend that we are thinking it is, then you have to take your call. Are you going to let yourself be bothered by the fact that there could be 1 year of underperformance or some even negative performance? Or are you going to look at the 5-year, 7-year picture and say these stocks can grow even further from here, and we should be in the riding wave rather than trying to be cheeky about the correction? I'll give you an analogy, like let's say late 90s IT sector. IT sector was growing 150% kind of a growth rate. Obviously, those kind of growth rate cannot sustain for a long period of time. And that culminated into the dot-com bubble. I don't think we have reached that kind of a phase where we can say it is bubble. They are expensive, and they are expensive because they are growing very, very fast. The scale of these companies will change dramatically over the next 5-7 years. So if that is the case, and if that scale change is combined with growth and profitability, then I think the companies can get even more expensive valued from here. So to cut the long story short, what I'm saying is, in the larger trend, there can be a year of underperformance, but I think the larger trend still we are very bullish on.
But irrespective of local elections, global elections, macro events, the themes which we've identified are themes which we've discussed with you: financial, energy transition, manufacturing. You are happy to own and happy to bet on these themes for at least 3 to 5 years.
No, I think so. The probability of these themes panning out has gotten even stronger and stronger. So let's take one theme that we are talking about, which is the Capex cycle. Clearly, Capex cycle, what was kickstarted by the central government Capex, is now this year will be the year when actually the proportion of private cycle, private companies contributing to the Capex cycle will increase this year. And I think you can see it in the sales order book of the listed companies that we are not, it's not like something we are hoping for. It is actually, the order book is already there. It's only about execution going forward. So the private Capex cycle is going to pan out this year. Second, energy transition as a theme. Again, within that also there are many buckets as we've already discussed in the past. But power transmission remains one theme that the probability of that keeps getting stronger and stronger, because unless we put our power transmission Capex in place, the energy transition entire theme will fail. So we need to put money as of yesterday in the power transmission. And when I say I'm talking for the entire globe. It is even India, even US, Europe, China, every continent needs to put up power transmission lines so that the renewables can be smartly connected to the grid.
Okay, so when you say power transmission, you're essentially looking at companies which are the second derivative beneficiaries. Transmission, power, meters, companies which essentially aid to the distribution of power.
So see, the way we go about selecting our subsectors is where is the delta going to be maximum and where the profit pool is going to be distributed amongst fewer companies, where the competition is not very, very high. There could be financiers also, like we have seen some of the power financiers are doing fantastically well. However, again, we want maximum delta combined with ability of few companies to capture that opportunity. So in that sense, yes, some of the power transmission companies, equipment companies are very well positioned. There is very less competition over here. And overnight, there cannot be new players entering this sector. So that is what is exciting us at this point.
The Reserve Bank of India has made big changes on liquidity. The scrutiny and the monitoring of NBFCs has increased. You're betting on NBFCs, let's say names like Five Star, Home First. Why are you betting on NBFCs at a time when the liquidity is actually moving against them?
So I think the liquidity issue is also the issue of the last 6 months. I think going forward, the liquidity situation will ease. I think a lot of it was also related to the fact that we were heading into a election season as well as a tax season. So both of those things have kind of panned out now. I expect liquidity to start easing. I think RBI in this particular meeting that they are scheduled for this week should hopefully announce some measures to ease the liquidity. So market moves anticipating what's going to be there in the future. And if you look at it from the point of view of growth rate, return ratios, asset quality, these companies are doing fantastically well. So all they need is that little bit of assurance that margins are not going to be under a lot of pressure and the stocks will start rallying from here again.
Why are private banks not chipping in? I mean, there is a serious case why they should do well. Leverage is low, their cost to income ratios are decent, they are getting lion's share of fresh deposits, even though it's challenging, but they're still getting lion's share of deposit. But from a market standpoint, private banks have been massive underperformers.
So a couple of reasons, couple of fundamental reasons and couple of technical reasons. The fundamental reason is essentially the names were under pressure. The fight is on for the deposits and that is putting pressure on the names. That's number one. Number two, as you mentioned yourself, the liquidity was a little tight. Number three, the technical reasons that I would say is that, it is the largest FII owned sectors and FIIs in India have been kind of reducing their weightage because the valuations are making them uncomfortable. And the easiest way to, reduce weightage is to sell a little bit of financials because that's where the maximum holding is. However, just to give you a perspective, they used to own about 43% of the financials free float. It's come down to almost 31-32%. And nothing to say that it cannot go down further, but I believe that now the positioning has corrected itself. And if the FII money was to flow back into the markets, then financials will also find a place in their portfolio.
Banks versus IT versus banks, go for banks. But when it comes to banks versus pharma, where do you see higher delta?
So pharma is no more a homogeneous sector. I think you'll have to take each story on its own. Each story differs. Where there are various buckets. So whether it's a oral solid generic US focused generic play, then that is not something that excites us. But if there are let's say API companies, CDMO companies, biotech companies, inhaler companies, then there are diagnostics companies, hospital companies. So there are various buckets, domestic focused branded generic companies. So apart from the US focused oral solid generic business, which is kind of on a cyclical revival because the pricing pressure is kind of easing, that is not a very exciting story for us. It is a cyclical play, and it will pan itself out. And the companies actually over there who are heavily dependent on US generic will have to reinvent itself to kind of add a little bit more specialty to their portfolio, and that's been happening since the last 5-7 years. I won't say that it's something that realization has dawned right now. It's been happening, but it's been too slow, and this is a cycle that takes time.
The best consumer play in India? Is it still discretionary? Is it still durables? Is it still staples? What is the best way to bet on Indian consumer?
See, if your return profile is that you want to make maximum bang for the buck, then it cannot be the staples. It has to be discretionary. India is the last consumer left on the planet Earth, large block of last consumer that is yet to experience a consumption boom. If we are going to move from $3.5 trillion to $5 trillion economy, and our per capita is going to move from $2,500 to say towards $4,000, the jump in the discretionary consumption will be far more than the staples. Now, if that is the case, then you have to bet on discretionary consumption going forward. But discretionary consumption is a very, very, very broad theme. The three pillars on which the discretionary consumption boom rides is access, affordability, and availability. These are kind of, then you have to see which particular subsector is going to witness a J curve in the next 3 to 5 years. And that is what we will try and do to understand this is where the boom is coming. There might be some spaces like we are witnessing, for example, in the case of travel. Travel is witnessing a fantastic boom in the last 3 years post-COVID. And I think it is largely to do with the fact that it was a K-shaped recovery, and the top end of the consumer is actually doing quite well. We are witnessing that it's in travel, and we are witnessing it in the premium real estate as well. However, the bottom of the pyramid is not doing that well. For that entire mass consumption basket to pick up, I think the trickle-down effect as well as the pent-up demand of the last few years should pan out over the next 3-5 years.
Which are these categories? Have you identified something where J curve is around the corner or demand could surprise us?
No, that's where I think the work lies for us to do. I think right now it's an ignored space. People are not really so bullish on consumption, and that is why it's a good space to be looking at for the next. I would kind of qualify my statement by saying that I am also not seeing the revival around the corner, but it is a fertile space where we can witness revival, but we'll have to give it 2, 4, 6 quarters. I don't know exactly how long it will take.
Right. We have got a print of all-time high on the Nifty. The ring of a new all-time high as we speak is always something which you always look forward to. Ravi, at an all-time high, markets are trading at a mild premium to the historical averages. And if one really looks at the previous benchmark in terms of where markets have peaked out before they've topped out, even the Nifty has a long way to go. 20-21 times markets rarely peaks out.
Yeah, so actually more than valuation is only one aspect of it. For the markets to really peak out, and when I say peak, we are talking about peaks like March 92 peak, or January 2001 peak, or even just before global financial crisis. Those kind of peak happen when we have peak profitability, peak growth, peak leverage. All those kind of things have to come together for a market to form a major peak. As you rightly mentioned earlier, leverage is not at peak. The corporate sector is not leveraged. profitability and the drivers of growth and profitability are also not at peak. Not all of the engines are firing, not utilization levels is not at high. There is scope for gross margin and EBITDA margins to improve because of the operating leverage. All those kind of things tell you that valuations are high, but these are still slightly above long-term average, and the cycle is also still in the early stages. That is what gives us the confidence that you should be looking at 3 to 5 years. Corrections are part and parcel of the market. One cannot avoid corrections, and one should not even try. But the question you should be asking is, by investing at this level, am I making a cardinal sin of coming in at the top? I don't think this is the point of maximum optimism for the markets. From that perspective, I think we are okay.
Look at historical parameters. Markets speak out when there is excess participation in the derivative market, which is evident. There is a rush of IPOs, which is obvious, and there is a frenzy in small and mid-cap stocks, which I think cannot be denied. You typically have all the boxes which are ticking itself, which historically have also acted as indirect indicators of market top: retail, IPO, mid-cap activity, and also what's happening in the F&O market.
So you know what, Nikunj, you could have said, you could have ticked all these boxes 12 months back also. And you would have said, there is a excess participation of retail, F&O activity is going up, and the IPOs are happening, and all those kind of things. And you would have made the mistake of selling out. So as I mentioned, first of all, this endeavor to find the top is counterproductive. And if you try and do that very, very often, you'll most likely end up missing out on the market's move. So, however, coming back to what are the boxes that are not yet being ticked, which will tell you that this is a market peak. So one is, all the engines of growth are not yet firing. Exports, consumption, both are not yet firing. State Capex is going to pick up this year itself. So these are the engines on the growth side that are not yet delivered. On the operating leverage front, the utilization levels in the economy are at about 74-75%. That is not the peak. In fact, the private cycle Capex usually picks up steam post it crossing 78-80% kind of a number. And we are probably going to do that this year. So again, the Capex cycle and the numbers are going to pan out positively over the next 2-3 years. The third, in terms of valuations, I think it's just slightly above long-term valuation, long-term average does not qualify this to be a peak valuations on peak profitability. So the peak profitability is ahead of us, and peak valuations are also ahead of us. That is why we have, I can say we are comfortable holding on to our positions. But yes, finding new opportunities is becoming more and more challenging. It is not easy that you find opportunities which are like, eyes closed, just buy. Those kind of opportunities are very difficult to come by. So again, I would like to say that some of the things are ticked, not all of the things are ticked in terms of euphoria, bubble, bull market, however you want to classify it. And we can always witness a correction. So like we have just witnessed in SME, mid and small cap space, the froth is now out of the system and the earnings trajectory still remain very strong. In that kind of a scenario, you will always find a buyer. See, it's not a 2-5% kind of correction that I'm talking about. Some of the companies have corrected 30-40% as well. And that in that scenario, if the earnings still remain strong, then I think they will find a buyer at lower level.
All right, Ravi. Really appreciate your time. So glad you could join us with your valuable inputs. That's Ravi Dharamshi for you.
Thank you.
If you like this video, then like, share and subscribe to ET Now.